Hey guys, this is Toby Mathis, and I'm a tax attorney, and I'm going to go over the basics of option trading for beginners and also the stock market landlord method. And I'll explain what all this means, and I'll break it down in small bite-sized pieces. So number one, I'm not going to dive in and show you a bunch of charts. I'm not going to show you a bunch of stock tickers and everything. I'm going to tell you the concepts so that you can avoid making mistakes and make money instead, make good decisions. So here's my experience over the years, having been doing this for over 27 years, tax attorney. My firm does about 10,000 tax returns for investors every year, cut my teeth on the option world and making money in the stock market. And I would just say, statistically speaking, if you are an option buyer and you're trying to make money as an option buyer, which is all this sexy stuff, make $1 million in a year and all this, whenever you hear that, my research is about 80% of the time people lose money, that it's a significant amount of money that they lose, and studies back me up and show that only about 4.5% consistently make money. And there's studies going back 15 years. People have a real difficulty making money buying options. And I want to plant that seed out there, and then I'll explain what it is. So let's say we have a stock, ABC. And I'm just going to say ABC trades for $1 a share. You have the ability to buy an option on ABC if you want that allows you to pay $100, and it gives you a set amount of time. Now, options are traded in buckets of 100 shares. So it's 100, the option is on 100 shares. So if there is an option, let's say that I could buy the right to buy that stock for $100 and it's $1 a share, that means that I would pay $100 for the right to buy that company at $100 per share. Now, what if ABC goes down to $99? What if it stays at $100 and I have the right to buy it for $100 and I paid $1? Well, I'm at $1. So let's say that I have that option and it expires in 30 days. Now, it's not quite that clean. They have expiration dates, but let's just say I have a month out. That means that I paid $100 for the right to buy that company at $100 a share. Hopefully I have enough money to even buy it. But what I'm really hoping is that that company goes up from $100, and let's say it goes up to $110. Wow. Well, then my $100, depending on how much it moves and consistent to the price, all things being equal, it should go up. If for every dollar it goes up, my share price should go up $1, or my option value will go up. Now, as I get closer and closer to expiration, this dollar gets worse and worse and worse. So like if I buy it in a week, I'm probably buying the right to buy those shares at 25 cents. But what happens is if this guy does not move, if it goes down or stays the same, my option expires valueless. And so that's why I'm not a big fan of being an option buyer. Now let's flip this around. And instead, let's just say I own 100 shares of ABC and I paid $100. And instead of buying the option, I sell. This is called a call. I sell it at $100 a share, which equals $100 that I get to put in my pocket. So I have 100 shares of ABC and I sell, and let's just say next month expiration, for sake of ease of use. Again, expiration dates, when you look up an option train, not going to dive into that today because I don't want to confuse you any more than I probably already am. I want you just to think there's a future time when I get to exercise that option. I have a period of time. I could buy a week, a month, 6 months, a year. I could go out as long as there's a market for it. As long as it's available, I could buy it. Same token, as long as it's available, I could sell it. So I sell somebody, let's say for a month, the right to buy ABC at $100. Now, I don't know if I'd really do that. I'd probably choose a different strike price, but just for sake of argument, I get to keep $100. Now they buy my shares. Let's say that the company goes up to $102 and they exercise and they buy my shares at $100. I still keep my $100. I'm not going to get that profit that I would have gotten. But here's what happens. We do something here called the stock market landlord method, where we buy shares of companies, and companies tend to go up statistically over time about 10% a year. That's what the S&P's growth rate is. Depends on the company that you're looking at. But if you're buying bread and butter companies, they do tend to go up over time. So what you do is, instead of selling that 100, maybe you're selling a 105 option. And maybe instead of getting $1, you're going to get 50 cents per share. So now I am getting $50 every month, and I sell that same option. It expires, I sell another one, it expires, I sell another one. Or maybe it goes down in value and I buy it back. But I sell options on my company that's sitting there. Maybe it goes up to 101, it goes up to 102, it goes up to 103. I start getting nervous. Oh, shoot, am I going to get called out? No, it doesn't go up 5% in a month. It sits there, and I get to collect that revenue. Now, these numbers fluctuate, first off, so you should know that. But I can find companies that consistently will allow me to generate decent premium, and I get to keep that money no matter what. Now, let's say that ABC goes up to $106. And I sold someone the right to buy it from me for $105. Okay, I kept my 50 bucks, but I also got the profit of $5 per share. So I'm also going to make that 500 bucks too. So I'm out ahead 500 plus the 50 bucks. The idea is that we are actually consistently making money on the company by selling options. Now, the other thing we do is, when I buy a company, and I don't want it to be fluctuating wildly like growth stocks sometimes do, I am going to buy a dividend company, a company that pays out a dividend. I tend to focus on 2% or 3%, because what it does is it keeps the stock price lower because they're not retaining income. So they're paying it out to the shareholders. So I would receive every year, let's say I had 100 shares of ABC at 100 bucks, and it pays out a dividend of 2%. And yay, right? I'm also getting 20 bucks a year in a dividend as well. So I'm making all these little profits rolling around by owning those shares. That's the idea behind being a stock market landlord. Now, some of you guys are saying, but I don't have enough money to buy 100 shares. Okay, there are synthetic covered calls, is what they're called, that you could also learn. I don't want to get there. For beginners, I really believe what you want to do is start accumulating good dividend stocks. And I'm talking about, there's something called aristocrats and kings. These are companies that have been increasing their dividend every year for 25 years. In the case of aristocrats, it's 25 years, and they're over $1 billion market share company, and or market valuation. And also, if you're a king, that's 50 years. There's only like 26 dividend kings. It's always right around 30 or less at any given time. Very few companies pay out and can consistently be paying out their shareholders. You find them, they tend to be very stable companies. You're able to get a nice revenue stream. Usually you get an extra, let's just say we did this every month, we'd get an extra, whatever that is, 300 bucks. We're getting a nice return, an extra 3% or whatever it is. I think I put, this is wrong, it's probably 200 bucks, whatever it is. But I'm getting money every month, and I'm consistently getting that extra revenue every month, or actually 50, yeah, it's 600 bucks a year. I'm getting a nice payment, just because I'm doing the options, just because I'm doing those dividends. I'm making money whether I sell it or not. Now, what we'd like to do, just like we do in real estate, is we want to accumulate assets that continue to appreciate. So I buy single families, I buy apartments, I buy all these different types of real estate. You don't leave them vacant. In the stock market, I would argue that you don't buy companies and leave them vacant. They need to be paying you something. So a lot of folks get enamored with growth stocks. They hear this term growth stocks, and they immediately go and say, wow, this is, I buy it low and I sell it high. I buy it at 100 bucks and it's going to be 150 bucks in a year. Okay, that's great if it actually goes up to 150 bucks, but do you know how many companies actually do? Right? It's few and far between. Statistically, over time, companies grow. at around 10% a year in the S&P 500, which is the 500 biggest companies in the market. Overall, the total market, it might be down a little bit below that, around 7-8%, right? It's not going up to 150 every year. Statistically, that 100 at the end of the year is going to be worth about 105, 107, right? But we're also getting our premium. We're not leaving it vacant. And we're also getting our dividends that are being paid out. The percentage that I'm getting paid out. So let's just say it was whatever amount it is on an annual basis. I'm getting my dividend plus I'm getting my my call premium, and I am going to keep the shares. I don't have to sell the company. So at the very beginning, I talked about the difference in philosophy of people that buy options and people that sell options, and I say you're going to be better off selling. This is why you're better off selling. You only have to be right on one thing. I sell the option. If the company goes up in value, I make money. If it stays the same, I make money. If it goes down in value, I still made money. I still get to keep my premium. Whereas if I am an option buyer and it stays the same, I lose money. If it goes down in value, I lose money. If it goes up in value beyond my strike price, then I can actually make money. So I have to be right. Oh man, oh my gosh, I'm toast. I have to be right way more often, right? It's crazy. I do not want to be in that situation. For all you option buyers out there, you know what I'm saying. For someone who's just getting started, you would not say, hey, go be a high frequency trader and doing option trading. It's a recipe for disaster. We see it over and over and over again. People go out there, they find some guru that's supposedly making 80% a year returns. If they were making that, they wouldn't be out selling a course, guys, right? If that's what they do, hey, I'll give you the secret. There's no secret, right? If you want to get wealthy, do consistent things, small, over time, let them compound, get that growth. That's great. Now, I'm a tax attorney. I'm self-motivated. I want you guys to get wealthy, so you use us for asset protection and tax planning. I've been teaching this stuff for years and years and years to our clients because it helps them make more money and get more tax problems that we can then help them solve, and that helps out our law firm. I don't understand the people that are out there saying, I'm making 300% returns a year. You can too, right? It doesn't really exist. In my experience, and I've seen a bunch of those folks, they're out there, it's all a bunch of hot air. It's very few and far between that the people that are the option buyers that actually make money. It's in the single digits, study after study. My experience is about 80% lose, and the studies that I've seen, the amount of loss statistically in the first year is usually over 30% of that portfolio. So people that go out there and try to be option buyers tend to get beat up. People that are option sellers tend to make money consistently over time. In fact, there's a great ETF, if you want to just look at it. It's DIVO. It's Kevin Simpson. I've had him on my channel a number of times. And where they institutionally, with billions of dollars, I think it's over 12 billion now, consistently use this approach to create great returns for their clients. And I think last time I checked, they were over 13% a year. They consistently make money. And that's the secret, guys, is to consistently make money. Don't let something sit there and not pay you. You know, your dollars are little soldiers. They got to go out and catch prisoners, right? You don't want them sitting at home. You don't want your army just sitting at home, lounging around doing nothing. We don't want to park it in something that we're hoping and praying, oh boy, I hope it goes up. No, you need to be making whether the market's going sideways, whether the market's going down or up. You need to be making money under all of those circumstances, and that's why you become a stock market landlord. If this is appealing to you, by the way, there's a great book, Infinity Investing, that I wrote that actually covers this and also a bunch of other topics underneath financial planning and how you can make more money. I'll give it to you absolutely free. All you have to do is go down below in the comments, because you got this far, and type in free book, and we will send you a ebook version of it, or a link so that you could download an ebook version of Infinity Investing, How the Rich Get Richer, and how you can do the same, absolutely free. If you like this type of information, please like and subscribe. And by all means, if you know anybody who would benefit from this information, please forward it.